looking forward 5 or 10 years, it would be flipped, and you'd really need to kind of differentiate. And so I thought, well, what's the opposite of artificial intelligence? It's human intelligence.
All right, we are back with episode 5 of Building Better Portfolios. I am your co-host, Paisley Nardini, joined by our other host, Josh Flade. And we're super excited to have Zack Ellison join us today for episode 5. And Zack has a very interesting, unique background, which is why we wanted him to be on the podcast. Zack has spent the better part of his career now in corporate credit, high yield bonds, CDS, all of this parts of the market, culmination coming to what we're talking about today, which is venture debt. This is probably an area of the investment universe or landscape that many of us don't have a lot of experience on. So part of what we want to talk about today is a little bit of education, but also really focusing on where there are opportunities. Why is this such an exciting asset class? And Zack has been very formative in this industry with not only launching his own business and fund, but also helping drive a lot of that education. He's even authored pieces for the CFA curriculum to help educate and help really raise awareness on why this should be a strong part of a lot of investor portfolios that are looking for yield, that are looking for appreciation, and are looking for diversification. So Zack, thank you for joining us today. You have a bit of alphabet soup at the end of your name, which Josh and I are also kind of nerdy. So we appreciate that. But I think there's also some additional letters that are about to come at the end of your name. Do you want to share what you're working on right now?
Yeah, no, I appreciate that. And first of all, thanks for having me on, Paisley and Josh. I like what you guys are doing with the program in terms of just educating people on the investing space, and venture debt and growth credit obviously is an area that is becoming much more prevalent, but is still really misunderstood. So I always appreciate the opportunity to talk about and educate people on it. Yeah, so in terms of the alphabet soup, that all started in 2004 when I graduated from undergrad, and I was just thinking about, in my first job actually, I was at a company called Thomson, which became Thomson Reuters, and Thomson was the biggest corporation in Canada at the time. And I was doing equity market surveillance, which was basically helping publicly traded companies understand their shareholder base and helping protect against activist investors. Because activists would come in and accumulate positions and then do things that the company might not like. And so the companies, 98% of the Fortune 500 actually worked with Thomson, would engage us to help monitor who is buying and selling their stock, but also help position their investor relations teams to tell the story better so they could attract the right types of capital. So at that point, I spent a lot of my time reading the sell-side research that was produced by the banks, many of which are no longer around today, like Lehman Brothers and Bear Stearns and Wachovia. And back then, sell-side research was much more prevalent and impactful. It actually drove a lot of reaction in stock prices. And so I was reading research every day, determining what the analysts thought about various stocks that I covered. And I realized that almost everybody had the CFA after their name. And most of the top analysts also had done an MBA at a top 10 school. And so I had no idea what the CFA was prior to that. I'd gone to a liberal arts college at Swarthmore College in Pennsylvania and barely even knew how to use Excel when I got out of college. I think I'd used Excel twice in my life when I graduated. And so I thought, okay, here's what I need to do. I need to get the CFA because it seems like all the smart, impactful people have that. And I should probably get an MBA too. So basically I started out studying for the CFA and finished that in 2007. And I went 3 for 3, right? And back when it was only offered once a year.
Yeah.
And then in 2007, I was at Scotiabank in New York underwriting media and telecom loans and some technology loans as well. And at that point, I passed the first 2 levels of the CFA at Thomson. And so I had to do level 3 when I had moved over to Scotia. And this was in New York. And I don't know if you know much about Canadian investment shops and banks, but everybody there not everybody, but the majority of people have the CFA, which is a little bit different from the US where a lot of people don't. And so everybody on the team had the CFA and they'd all gone like 3 for 3. And
No
so
pressure.
there's all this like they're like, oh, no pressure, and I'm thinking I'm going to be the only person in the history of this banking team that didn't pass the CFA, going 3 for 3. So
Not the
thankfully I did.
statistic you want to be.
So thankfully they were supportive, and I studied really hard and passed it. And so I finished the CFA. I guess that was in 2008 that I got the designation, and then worked for Scotia through the financial crisis, and that went really well in terms of our performance, even though the world fell apart between 2008 and 2010. But we had amongst the fewest loan losses in the world at that time. And I really attribute that to the institution and the team, and I was able to learn a lot from them. And so in 2010, I decided to go back to business school at University of Chicago, and did a full-time MBA at Chicago Booth. And then when I came out, I moved to bond trading, and so at Deutsche Bank at 60 Wall Street. So that was pretty cool because it was the biggest bank in the world at the time. We had 2.8 trillion in assets, and this was 2012 that I started full time at Deutsche. And we led the Apple deal, which was the biggest bond deal in history at the time, 16.5 billion. That was traded off of my trading desk, and the lead trader sat right next to me. And so that was like really, really cool because I got to just see the biggest deal in the world being led by our not only our bank but our team and one of my friends that sat next to me. So that was neat. And then from there, I did a couple of years at Deutsche, and then a number of clients wanted to hire me to go to the buy side, and so I wound up going to Sun Life, which was at that point my third Canadian institution.
Yeah, I was going to say there's a theme here, Zach.
Yeah, but all were in the U.S. And so Sun Life was actually and is still in the U.S., based out of Wellesley, Mass, which is just down the road from Boston. And funny enough, about 10 minutes from where I went to high school. And so I chose Sun Life over some other top tier shops because I really wanted to just be closer to my mom at the time in Boston. And I also felt like it was an interesting opportunity because they were one of the biggest asset managers out there. So long story short, was there for 4 years as director of fixed income and helped manage 25 billion in mostly corporate credit assets. And that went really well. We had great performance. And then I did one more stop on the sell side at another bond trading firm in New York. And then I had an epiphany, and this is where we get to the good stuff, which is that there wasn't really going to be much alpha opportunity in public fixed income, public corporate bonds. And so I felt like I really wanted to transition my career into the private segment, private credit specifically. And and when I started looking at different private credit strategies, I really was intrigued by what's called venture debt. And some people might call it growth credit. Basically what it is it's loans to early stage companies. And the venture part of it means that you're making a loan to a venture-backed company. If you make a loan to a non-venture backed or non-sponsored company, it would just be called like a growth loan or a growth credit. So the only difference there really is the sponsorship. So long story short, I decided I was going to move from New York to LA, where I wanted to live for quite some time because I was just sick of the cold weather, having lived in New York and Boston and Chicago and gone to school near Philly. So I was kind of done with the snow and the dark days. And so I moved out to Santa Monica and lived about a mile south of the Santa Monica Pier, just north of Venice Beach. And that was amazing. And long story short there is that I basically started building out my firm, A.R.I, Applied Real Intelligence, which is a growth credit shop. So we basically make loans to early stage companies, and then with some of these companies we also do other types of financings, whether it's like convertible notes or helping them with equity raises. But the core strategy is really loans to companies doing 10 to 100 million in revenue that are growing quickly. And it's gone great. Like, it took a hell of a long time to build it, and now we're being recognized as one of the leaders in the space. And we've got some deals that will be announced publicly that will be very newsworthy, to put it mildly. Game-changing deals that that will be out there at some point in the next probably 6 months.
Okay,
So
super exciting.
pretty exciting.
Yeah, so maybe a quick question on that. Thinking about when you first launched ARI, which just so everybody's aware, ARI stands for Applied Real Intelligence. Is that correct?
Yeah.
Yeah. So do you call it ARI or ARI or
No,
anything for
no,
just
we call
ARI?
it A.R.I, and it's really a play on AI because
Got
everything
it.
that's going on today, I foresaw in the sense that I knew AI was going to become kind of like the dominant force in the market, and so you'd have to differentiate in the opposite direction versus like 5 or 10 years ago. Because it used to be that everything was done by humans, and you'd say, oh well, there's this 10% that's performed by AI or automated in some way, right? But I felt like looking forward 5 or 10 years, it would be flipped, and you'd really need to kind of differentiate. And so I thought, well, what's the opposite of artificial intelligence? It's human intelligence, and it's really applied real intelligence. To
Yeah.
me, real intelligence is human intelligence, and so that was kind of just why I came up with that name. I just thought it was just kind of fitting in the sense that, of course, we use technology and we invest in AI, but ultimately there's a lot of subjectiveness and a lot of strategy that goes into what we do that AI can't really do at this stage. Maybe in 10 years it can, but at this point, I think the best investment decisions are still based on what humans do really well by applying their intelligence, and especially in the private markets where a lot of success is based on relationships and
Yeah.
negotiation. It's very different than the public markets where there's kind of ubiquitous information flow. There's very little information asymmetry, and like what you and Josh might know about a particular public company, I would know as well in real time. Like if we're
Yeah.
on Bloomberg and we're all kind of reading from the same sources, we're going to have very very similar information. And informational edge is very hard to gain, and you have to dig very very deep in the public markets to have an informational edge. You need to have a team
Yes.
of a couple hundred data scientists to look at alternative data to try to dig out some edge, and ultimately that edge isn't going to produce much anyway. Maybe it produces a few basis points of excess return, in my opinion. In many cases it doesn't produce anything, and you probably probably perform worse than the index. But in the private markets it's very different. You can have information that only a handful of people on earth know about, and you can know, who's investing and what the company is doing and what their competitors are doing, and it's simply just not public. And so it's very easy, if you're good at what you do, to create informational advantage. And then on top of that, you can have other types of advantages in terms of structuring legal documents and financial structures that at this point aren't really easily done by AI. It still involves smart lawyers and smart financial structures. And then of course the negotiating aspect. Every private deal that I've seen ever involves a lot of negotiation. And so it's not really AI or information in the financial sense. It's not the financial information that's the edge. I mean, that's the easiest part. That's like 1% of a total deal is really like analyzing the financials. It's really all the nuanced stuff around how did you source the deal, what do you know that others don't, how did you negotiate it, how did you structure it, and to me, like, that's applying real intelligence.
Yeah, I love that. Go
Zach,
ahead, Josh.
on that note, can you just so for somebody who's listening who hasn't ever heard of venture-backed debt, can you just walk us through an example of what a venture-backed debt deal looks like, and maybe even talk about like zero-cost warrants or anything along those lines?
Sure, great question, Josh. And most people don't know, and it's pretty simple. So tell me if I miss anything in terms of what listeners might want to know. So essentially, most of these loans are senior secured term loans, and they're typically, on average, 3 years in maturity. But it can range. It could be 2 years or 4 years. I rarely have seen any loans that are longer than 5 years, and a lot of the loans get paid down early, which we'll talk about the reasons behind that. So think of it as kind of on average a 2 to 4 year senior secured term loan. It's typically backed by all of the assets of the company. So the lender will have a first lien on all of the company's assets, which include things like intellectual property, which oftentimes is a big part of the asset value for early stage companies that don't typically have a lot of physical hard assets in terms of like property or equipment, but they oftentimes have valuable intellectual property. Right? And a lot of these are asset-light companies in the technology space. So it's the IP is oftentimes what is creating that value over the long run. So you're basically lending against, you're lending to these companies that are asset-light, and essentially what you're analyzing is what's the enterprise value of this company, and what does its revenue profile look like? Because they're typically not profitable. Or they're maybe they're break even or slightly profitable, but these are not mature companies that are kicking off positive cash flow because they're still in growth mode, oftentimes hyper growth mode. So essentially, as the lender, you'll come in and offer a 3-year loan. It's senior secured. It'll typically be on average, call it like a 1-year interest only period on the loan, and then the loan will start to amortize, meaning the principal will start to get paid down after that, typically in equal installments, which we call straight line amortization. So with a 3-year loan with a 12-month interest only or IO period, you'd only be paying interest the first 12 months as a borrower, and then in the remaining 2 years you'd pay in equal installments the principal back plus whatever interest was due on that principal. So what's nice is most of the loans are floating rate as well. They're typically a prime rate or SOFR plus a spread. And the all-in cash interest rate is typically in the non-bank market, meaning loans from lenders who aren't banks like Silicon Valley Bank or Bridge Bank or Comerica. The average rate is kind of in that mid-teens, call it like 15% plus or minus.
And is that pretty consistent, Zach? I mean, I'm sure it's different with different companies, different deals, et cetera, but that obviously is a pretty high number that I think a lot of listeners are thinking, oh, like this would be an attractive part of the portfolio, especially for income needs.
I think you'll see it be lower than that if it's larger companies that have less perceived risk, or just stronger sponsor backing, which we should definitely talk about in a minute. So it can range widely, right? So I oftentimes will, be at a conference and speaking, and some other venture lender will say, "Oh, 15%. That's not what the market is." And maybe for you it's not, because you're getting 10%, 11%, 12%, but for us it is, right? So the market is very diverse, right? And so it's kind of like you can't really compare what we're doing at A.R.I. with what like Hercules Capital is doing, because we're both technically venture lenders.
Yep.
But
And I would say too, like private markets, generally speaking, tend to be higher dispersion. So that's helpful, and I think important. And most of our listeners understand that as well.
Yeah. So you're typically going to see large dispersion, but generally the interest rate in the non-bank market for the typical venture borrower is going to be in like that mid-teens range. And then the other characteristic that's really important is there's typically equity warrants attached to the loan. So that's a nice sweetener that also aligns incentives between the borrower and the lender. And so typically, again, that can range greatly too in terms of the size of the warrants, the warrant package, and how they're structured. So warrants, for those that don't know, are just call options or the right to buy stock in the company. Now, oftentimes in a situation where the lender has more negotiating power, they can structure it so the strike price or the price they pay to exercise that option to buy a share of stock can be very low as a penny per share, which would be called a penny strike. So imagine that I'm making a loan to you, Paisley, and the loan's a $10 million loan. And let's say I wanted $2 million worth of equity, right? $2 million worth of warrants. That you'd call that warrant coverage. So 2 million divided by 10 is 20%. So in the market, they'd say you're getting 20% warrant coverage. Then what we do is we negotiate. So that's essentially like the value we're trying to get to. But then we would also then negotiate the strike price, the term, like how long I have to exercise those warrants. Typically, it's up to 10 years in many cases. But again, highly variable. Sometimes it might be 5 years or 3 years, and the strike price can vary immensely. But suffice it to say, the key takeaway is what really is nice about venture lending from the lender's perspective and the investor's perspective that invests in our funds or alongside us is that you have this really stable income stream where it's like a mid-teens type income, annual yield, right? And then you've also got this upside that could make the investment return multiples of your initial capital if the company does really well, because you've got actual equity stock. And so essentially I think of it as equity returns, but with senior secured debt risk. And the other thing I should mention is that these are actually very low risk loans. So a lot of people will say, well, startups fail the majority of the time, 80, 90% of the time. But that's if you're measuring it from day one, when it's two people in their garage with their laptop and their dog, and they're coming up with an idea, and they put up a sign outside their house to sell lemonade with some tech component, and ultimately most of those businesses are going to fail. This is very different. You're coming in as the lender when the company already has significant traction, typically doing tens of millions a year in revenue already. So there might be a company that's doing 50 or 100 or 200 million in revenue, but they're still in hyper growth mode. So they are looking for capital to grow, and the reason they look to debt to pair with equity is it's less dilutive. Because if you think about the theory behind this as a founder, your goal is to keep as much as you can of the company you've built, so that when you exit, you, the founder, and the founding team and your employees have as much of the company as possible. And you want to minimize the amount that's going to the venture capitalists and your other investors, because you're not in this to get them rich. You're in this to be successful for yourself and your team, right? And so that's why you see a lot of founders now turning to this, because they're highly incentivized to optimize their capital structure so that they have enough capital to grow, but they're minimizing their weighted average cost of capital, because debt's a lot cheaper than equity. And they're also minimizing their dilution so they can keep more of the companies they've built. That's super helpful. So I don't know if that helps in terms of kind of framing it in terms of like what everyone's incentive structure is, because ultimately that's what matters in terms of success, is how incentives are aligned. And that's why the warrants are there, because it makes the lender much more likely to be a long-term partner, because even after the loan is paid off, they still have equity in the company. So they're still going to be incentivized for the company to be successful. And they're also going to take actions that will maximize not only the return on their loan, but also the return on their equity stake, which, if things go well, could be multiples of the return that they earn on the loan component.
Yeah, that's super helpful. One comment you made earlier that I want to backtrack and dig into a little bit is the comment on Silicon Valley Bank. And I read some of the research that you had put together. I think it was in the CFA publication around how that blow up of SVB in early 2023 kind of shifted just some of these bank-driven loans, and how that presented an opportunity for firms like yourself to become a greater slice of the pie, I would imagine, in some of these venture debt deals. So like, what was the significance of SVB on this space, and how has that kind of shaped your firm or the broader industry's kind of path over the last few years?
It's a great question. So SVB, for those that don't know, was the biggest venture lender by far, and they were a huge part of the market. At some points, it was estimated that they were 50 or 60% of the entire venture loan market at their peak. Excuse me. And Paisley, I want to go back to the question you asked in the beginning about, you had mentioned the alphabet soup after my name. So I never actually answered that question, but one of the new three more letters are coming, and it's that I'm getting a doctorate in business administration at University of Florida that I'm finishing up right now. And this is relevant to your question about SVB because my dissertation is actually about venture debt. And one of the things that I'm in the process of finalizing is my analysis on the collapse of SVB and how that impacted the market in terms of pricing of individual venture loans and also the structure of those loans. So the results aren't ready yet.
Stay tuned.
But I'll tell you what I'm basically looking at is the 2 years prior to their collapse, which occurred in the first quarter in March of 2023. So take the first the 8 quarters before that, right? And then take the 8 quarters after, which would go all the way through first quarter of 2025. And you can look at a difference in difference analysis where you're essentially saying, okay, what were the loan terms from a lot of the top lenders in the 2 year period before, and then in the 2 year period after. Because and this is actually like really interesting to academics and also practitioners, because at the time of the collapse and shortly thereafter, or actually for a long time thereafter, people thought this was going to really change the market because they thought SVB was going to be completely out of the market, and they thought that would mean there would be a lot of opportunity for competitors to step in. And they also thought that, hey, maybe this means less capital is available in terms of venture debt capital, and that would mean that the terms would probably become worse for borrowers, higher interest rates, more stringent terms, because there's less supply of capital, right? And that was kind of the hypothesis at the time in March and April and May. What's happened actually is that it was not accurate, right? And I'll know the exact details shortly, and they'll be published and you can read about them at the University of Florida's library or online. But suffice it to say that what's happened is venture debt volume is actually now at record levels. And that's despite the weakness that we've seen in the venture equity markets over the last couple of years. And for those that don't follow these markets closely, essentially venture capital, venture equity, had a boom year in 2021, just crazy bubbly year. A bunch of crappy deals got funded. So much money was poured into the early stage investing segment that it was kind of absurd. And most of those companies have fallen flat on their face. 90% plus are worth less than they were 4 years ago. Most are gone. There was something, I forget the exact number, but there were over 1,000 quote unicorns at that time. Probably will wind up being like less than 1% of those, or less than 1 or 2% probably actually make it into something material. So essentially the last couple of years, it's been really tough for equity folks because their portfolios have performed abysmally, right? And for borrowers or company founders that are looking for capital, whether it's equity capital or debt capital, they've had a really hard time raising equity capital. And the IPO markets have been largely shut, as you know. And so the larger companies that have wanted to IPO for the last 3 or 4 years just haven't been able to. So there's this giant backlog of companies that want to IPO and just can't because the market isn't there. And oops, sorry, I'm having a little trouble with my computer here. Yeah, okay. So we've got this like giant backlog of larger private companies that want to IPO. And so what they've had to do is they've had to really turn to venture debt as one of their funding options to extend their runway as they remain private for longer than they anticipated. And some of them are doing so by choice also, just because they could IPO, but the terms aren't necessarily that great right now. And so they'd like to wait and go public when it's more advantageous for them.
So
yeah.
I was just going to ask, I'm thinking about from more of like an access perspective, because I would assume, a lot of our listeners are probably in like an advisory capacity, working at an RIA. And so a lot of times when we talk about private markets, venture debt being one of them, I'm sure a big question is, from a risk return potential, this sounds really attractive in my portfolio. how do I access this? And I know there's been a lot of talk about interval funds for those that are maybe kind of smaller market type investors. Like how are they able to access how are they able to access venture debt at this juncture? And is it really still limited to kind of that private market space?
Yeah, so it's all private deals, and so the only way to really access it is through, well, there's a couple ways. Probably the easiest way for RIAs is to buy stock in a handful of BDCs, business development companies, that are publicly traded that specialize in making venture loans. So,
Okay.
as your listeners might know, BDCs make direct loans, right, that are private loans, but then they have publicly traded stock that's essentially these portfolios of private loans. And so there's different flavors, right, depending on what segment of the private credit universe each BDC is focused on. So there's 5 publicly traded BDCs that specialize in venture debt. These are all included in my dissertation, by the way,
Okay.
and I've actually analyzed every deal they've ever done because they're all publicly available in their SEC filings. So that's actually one of the things that's pretty cool about my research. It's the first deep dive into deal level pricing data ever, and so it's thousands of rows of data, and it took a lot of time to clean it up, to be honest. But suffice it to say that the companies are Hercules, Triple Point, Horizon, Trinity, and Runway Capital. Those are the kind of the big 5. And then there's a couple other folks that do it that have private fund structures. And what I would say is, this is a great product to have if you're already comfortable in alternatives. We have we have a fund, the A.R.I Senior Secured Growth Credit Fund, super successful. It's closed to new investors. We're on to the next fund right now, which we'll launch.
Congrats.
Yeah, thank you. I mean, it was an incredibly hard lift because people just didn't understand the product.
Yeah.
I first started building it during COVID, and so you couldn't even get a meeting with people in person. I probably talked to 5,000 LPs over the last 4 or 5 years, though, about
Wow.
to educate them on it. So the good news is everybody in the space knows who I am. The bad news is 99.9% of them didn't get involved and missed out on huge
Yep.
returns. But there's still more to be had, but they missed.
Yeah.
They missed
FOMO will have them coming back for fun too.
Oh yeah, wait till I announce some of the deals I'm working on now. They're going to be like banging down the door. So,
Good problem to have, Zach.
but yeah. So basically, in terms of private funds, there's a number of good private funds. I know who they all are and know most of the folks that run them, and I think they're great funds. Like I would invest my own money in them if I wasn't investing it all in my own fund, right? But here's the thing: it's really like not that hard to access them if you're already well versed in privates, because it's usually what's going to be called a drawdown fund, meaning you're going to commit a certain amount of capital to XYZ private venture debt fund, and then they're going to go out and they're going to do deals. And as they do each deal, they're going to draw down your money and invest it in the deal. This is actually a great structure that's used in the majority of private credit and private equity funds. So it's nothing new to the market, but it's new to most RIAs who are usually just investing in public security. So they get really, really flustered by the fact that there's this new structure. It's got a drawdown structure. It's got slightly different reporting, and that you're going to get a K1 for tax purposes. They don't want to deal with K1s if they've dealt with them at all, right? And ultimately, that to me has been probably the biggest gating issue in terms of getting a broader segment of the universe involved has just been the mechanical stuff and the lack of familiarity with it in terms of just not understanding the structure and how it's actually better for them because they have the money in their control until the deals are done, and then they're deploying it so their IRR is going to be much higher, and they're going to have a lot more control. The other thing I notice is that a lot of folks really don't like the idea of not having liquidity. So, I mean, they do in a sense because, again, the capital's in their control until it's called. So in the first year or two of a fund, they're going to have a ton of liquidity in the sense that they can do whatever they want with that money as long as it's there when called. But not having the ability to exit by touching a button on their phone or their computer really flusters a lot of folks. And so that's why we have seen a decent amount of interest in interval funds, which provide limited liquidity. But if you think about it, that's just such a garbage marketing tool because it's the liquidity is so limited. It's like 5%
It is.
per quarter.
As someone who has invested personally in interval funds, yes, quarterly gates to get out, but it's not what it always means on the surface. And so I think to your point, from a psychology perspective, there is a benefit actually to requiring investors to have capital locked up sometimes because they don't have those biases or those emotional decisions of pulling out capital at the inopportune times. So yeah, absolutely makes sense. And I just want to be cognizant of time as well. One other question I did want to ask you, Zach, just given you've touched parts of this market, is the future of sports investing. I know that's a very broad topic. We don't have a lot of time to unpack here. But I think it's something that, just broadly speaking, a lot of people that may not have as much investment acumen but understand sports and think it's really cool and fun to invest in them. But it is a growing part of the market. So if you could just share like how that's touched part of what you're doing and kind of where you see that market going.
Yeah, and if it's helpful, I can go a little bit longer. I have another meeting, but I can push that. So if you want to go another 15 minutes, we can.
Yeah, even 5 or 10 minutes is fine too.
Sure. So yeah, because the sports angle deserves some focus. So I'm heavily involved because we've made a number of investments in the sports space, early stage, right? And I happen to I used to bank actually 3 of the major league sports leagues back when I was at Scotiabank. And I was also doing like media banking. So it was the NBA, NFL, and Major League Baseball were all clients. And so from a very young age on the business side, almost 20 years ago, I started in the space. And it's always been important to me as a former basketball player and somebody who loves sports. And so it's definitely a fun segment. And what we've seen is just an explosion in the value of professional sports franchises. Mm-hmm. And of course, what that's led to is a lot of folks that are trying to build like the next layer or the third layer or the fourth layer under those sports, right? So you've got like the NBA, but then you're going to have minor leagues to that. And now you've got like the big 3, Ice Cubes, 3-on-3 basketball league. And then of course, women's sports are taking off too. And there's new sports that nobody even knew about 20 years ago, like pickleball, that are now really popular. And so
I play pickleball.
Yeah. And so I guess like my takeaway is there's massive interest in this because at the highest end, with the professional sports franchises, money and valuation don't matter because it's the richest people on earth buying toys, right? If I had $100 billion, like what do I care if I have to spend $10 billion on XYZ team that I loved growing up as a kid, right? So I can finally, be part of the cool group, right?
Yeah. Living out the glory days.
And like, look, not knocking any of these guys, I know a majority of them, right? And so, it's just, they would probably admit it themselves. They're like, I don't care what I paid for it. Like, what else am I going to spend my billions on, right?
Yeah.
Now, what that's led to, though, is this trickle-down effect where franchises and leagues that will never have an audience, are trying to come to market and raise capital, and under the pretense that, hey, if the Boston Celtics are worth X and the New England Patriots are worth Y, well then our sports league should also be worth something, or our team should be worth something. My underlying thesis is that the majority of these are not going to be worth anything, and they're just going to be, ultimately a bad investment. Why is that? Because there's a limited amount of hours in the day, right? And just because I like basketball, and I do, like I probably know more about basketball from the 90s than almost anybody on the planet. Quick side note, I I actually, when I was interviewing for trading roles when I was at Chicago booth, one of the things that I had on my resume was that I could name the college of every NBA player. Love the history, basically, right? I mean, within reason. Like I didn't know like the college of like where like somebody in 1962 went to school that played for 5 minutes for the
I
Knicks.
started today's conversation by calling us all a nerd, but I think
Yeah.
you take the cake
Oh,
then, Zach.
well, I'll tell you some amazing stories. I was on, yeah, there were multiple trading floors I was on where I was interviewing still, right? Super competitive process for these jobs coming out of Chicago in 2012, or that's when I graduated, but this was like 2010, 2011. I was interviewing, and they would just bring me on the floor, and they would just start. They'd have like all the people on the floor had put in names to ask me in advance because they saw this on my resume, and they just, I knew it would get their attention, right? Because that was why I put it there. I said every single guy on the trading floor is going to want to
Yep.
like ask
Yeah.
about this to see if they can break me. And so they would just start yelling out names across the trading floor, and they'd have me like standing up in front,
Rapid
and I
fire.
would just have to like knock them down, and I would, right? And so like, even when I got to Deutsche Bank, we had to do like desk rotations, and as part of like the MBA training program, which was top tier program, like DB was the best. And so when I was on one of the desks I was on, again, it kind of started like that because they don't really know you when you come on the desk. They just have your resume and know that
Yeah.
you're going to get a job somewhere. You just don't know which desk you're going to be on at that point. And so one desk, I think it was the FX desk at DV, which is like number one in the world. They had a list of 100 names, and they're like, we're gonna go rapid fire, and we're gonna see how many of these you can get. And it was like they did 100 names in like 2 minutes or something. It was something ridiculous.
It's like when you're at the gym and like you can't go home until you've made like 15 free throws in a row. For you, it's like you don't get to leave the desk until you've named off 50 colleges.
Yes. So it was nuts. So I wound up, I think I got like 98 out of 100 or something. And then the last story I'll tell about this was that there was one interview with it was a bulge bracket bank. I won't tell you who, but they're still around. And they brought me in and they said, okay, I got good news and bad news. This is like a final interview. It was like final interview day. So they're interviewing like, 10 people from booth to see who they're going to give the offer to, right? So I get in and they said, I got good news and bad news. I'm gonna name 10 NBA players. We picked them off this list, and if you don't get all 10, you're out of here. But if you get all 10, like then you're in good shape.
Seems like a good hiring quality. Yeah, makes sense.
So they hit me with all 10. I went 10 for 10, and they're like, interview's over, job's yours. What do you want to talk about? And so I'm like, so we started like.
You're like, I'm not even qualified for the actual job, but okay.
So my first question was, what about that told you enough to hire me over everyone else from the best business school in the country? And they said, well, we already know your background. Like clearly you're smart because you're at Chicago. You've worked at Scotia Bank and Thompson, and have the CFA, et cetera. But what got our attention was two things: that you need to be a great trader, and this is what they said. I'm not gonna like edit it. They were like, well, one is that you have the balls to put that on your resume, right? Because we're gonna call you out on it and put you on the spot. And two is that you've got a great memory. And to be a trader, having a great memory is incredibly important because what you're ultimately doing is you're remembering patterns or matching patterns in the past, and you're remembering information about clients. Like, what did BlackRock do on this trade 2 years ago? What did this portfolio manager say from PIMCO 6 months ago? How many bonds did I trade with this trader at this price last week? If you don't know that, you're not going to make it. And so that was it. That's all they needed to know. They already knew I was, had all the other boxes checked. That's why they're at Chicago booth and not Joe Schmo University, right? And that was it. And so ultimately it was kind of funny because I wound up getting offers from basically every bank in the country that had a reputable trading desk. Went to DB, and and the rest is kind of history. But I just always thought that was kind of funny because when younger people ask me like, how do you get a good job? How do you break in?
Yeah.
It's not the way you think.
It never is. You have to bring something unique to the table. You have to stand out.
Yeah, set yourself apart. Yeah.
Yeah. And I know Josh has to hop.
Yeah, sorry, I've got to jump on an investment committee. So Zach, so nice to meet you. I personally have invested in some venture debt deals, so I love the space.
Nice. Well, we'll have to talk later. I'll get you in some better deals.
Good.
Yeah, I like that.
Okay, hey, thank you
All right,
guys.
see you, Josh.
See ya.
Yeah,
right.
yeah.
Thanks, Josh.
And we'll wrap up here too, Zach. I know you have to hop and you've
Yep.
afforded us a lot of time, but I do want to ask one last question.
Sure.
And this is usually, I think, an opportunity for you to kind of reflect on your career and things that have stuck out for you, things that have helped propel you to the success that you've obviously found. And that is the question of like, who is someone that's really made an impression on your career, that's really supported you, whether it's mentorship, sponsorship, and sometimes it's even like teaching you the hard lessons, but anybody that you would like give a shout out to or that pops up in your mind when you reflect on where you've come from.
Yeah, I mean, it's not even close. It's my mother, right? I mean, because this is one of the things that I think a lot of people don't know is that I was raised by a single mom. I never had any money growing up. Basically had less money than pretty much anybody I know in this business. And she was fantastic, though, in the sense that she was incredibly, or she is, she's incredibly smart. She's incredibly kind, and she really was very supportive of me growing up, and to this day. And so having that type of mother was the difference maker. And
well, I'm super excited for you. Like you said, you're finishing up your doctorate. I think the research that you are doing currently, the research and thought leadership that you've put out in the market already, people can go to your website to find a lot of links to some of your past newsletter research.
Yep.
And then super excited to keep our ears up for the news coming out in did you say the next couple weeks or months?
No, fourth quarter.
Fourth quarter, okay. Super excited to see where you're headed next. Just grateful to have the opportunity to chat with you today. Thank you for giving us the time. And hopefully this has put a bit of a light on venture debt as an asset class. I think like we started this is an interesting area for a lot of people that there's a big education gap. So hopefully this starts to kind of peel back those layers and people can dig in more, and you are the person if they have questions. So thank you, Zach.
Thank you for having me. I appreciate it.
Awesome.
The views and opinions expressed on this podcast are those of the host and do not reflect the views, opinions, or policies of any current or former employer, affiliated firm, or client. The content is provided for informational and entertainment purposes only and should not be considered investment, legal, or tax advice. Nothing discussed constitutes a recommendation to buy or sell any securities or investment products. Listeners should conduct their own research or consult with a qualified professional before making any financial decisions. The hosts are speaking solely in their personal capacities, and the podcast is not affiliated with, sponsored by, or endorsed by any firm or organization with which they may be associated.